Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. Well, with reporting season almost upon us, it's worth thinking about how domestic microeconomics might impact individual sectors and some of the companies within them. As you already know, our belief is that a speculative bubble in residential property has been fueled by rising household debt and falling savings. The resultant wealth effect, which was of course intended, has provided households with the flexibility to maintain their consumption levels. And as a result, we expect the higher quality companies in retailing, for example, such as JB Hi-Fi and Harvey Norman, to report strong results this season. Keep in mind, the residential housing construction activity peak has yet to occur, and so these businesses will remain supported until construction starts to fall, and associated activity and buying does too. But if you're an investor in these businesses, you definitely want to be dancing pretty close to the exit. We don't expect the outlook statements to be anything to worry about at the moment, partly because in both cases, the companies are run by optimistic entrepreneurs. Now, ultimately, debt must reach a ceiling, and when the pendulum eventually swings towards parsimony, discretionary spending-facing companies such as Myer, Big W, The Reject Shop, specialty fashion group Supercheap Auto, Noni B, and even Domino's could be in the firing line. The stronger Australian dollar will make buying online an attractive alternative to buying domestically, which will add another source of grievance for local operators. The Australian dollar's strength should also mean that outward bound travel remains well supported. Now, this could be a positive for the likes of Flight Centre and the airlines, but it could be a negative for domestic-facing tourism operators, such as Ardent Leisure, who has already reported a 30% decline in theme park visitation in June, and Village Roadshow. Adding to the pressure on households from record levels of debt is very low wage growth, and perhaps more, hitting the newspapers more, is a significant increase in household utility prices. Now, these increases in household utility prices will of course support the profits of some utility companies, like AGL for example. But for consumers, financial stress could rise even in the absence of interest rate increases. Generally, these forces don't bode well for retailers, and so we are understandably cautious about the future, even if results for 2017 prove strong. For banks, the most recent mortgage cycle saw a significant increase in the proportion of new mortgages written on an interest-only basis. In fact, data produced by APRA reveals that new interest-only mortgages are now 42% of all mortgages written, compared to just 21% of total new mortgages written in 2011. Now, many of these interest-only loans, if not most of them, will revert to principal and interest after 5 years. And the introduction of a 30% cap on the proportion of new interest-only mortgages that can be written by the banks will mean that many bank borrowers will be forced from interest-only loans to principal and interest loans. Now, this could mean that their repayments go up as much as 40%, and that's in the absence of an increase in interest rates. And keep in mind, the National Census told us that 34.5% of households have a mortgage, while 11%, 1/10 of all households, have more than one investment property mortgage. Record debt combined with rising interest rate charges and higher repayments will have a material impact on bank credit growth and discretionary spending by households. As an aside, leisure and gaming companies such as Tats Group and Tabcorp, who are already experiencing intense competition online, could also be impacted. At the very least, a moderation in bank balance sheet growth, which by the way is just a fancy way of talking about lower lending growth and ultimately lower earnings growth, is likely. Having said that, the banks generally are not on demanding market multiples, and factoring in a moderating outlook still suggests they look reasonably priced. They might prove an interesting alternative for those Telstra shareholders who are worried about the dividends there. But more on that in a moment. Another headwind that is likely to materialise later in the 17-18 financial year is a downturn in residential construction. Near-term results for building material suppliers such as Adelaide Brighton and Boral, and the builders and furniture retailers like Nick Scali should be positive because completions have yet to peak. But the recent decline in commencements indicates a future with lower levels of construction activity. Perhaps more importantly, growth in this sector has supported overall economic growth, but in 6 to 9 months, residential construction activity, along with its support, broadly could diminish. In the healthcare space, expectations for Healthscope are already low, amid uncertainty about rebates and encroachment by public hospitals into the private health insurance collections. So it could surprise on the upside. Cochlear and CSL could also surprise on the upside, but the stronger Australian dollar today might limit optimism for a 2018 continuation. And finally, in telecommunications, the capital allocation review going on at Telstra could mean a reduction in the 31-cent dividend, and all attention will be on any clues in that direction. Now, we don't expect the August dividend to be adjusted, but keep an eye out for any statements that suggest future dividends might be lower. For TPG, we'll have to wait until September, and for Vocus, remember the company has already provided guidance of a full-year profit of $160 million, and you might remember nearly $900 million was wiped from its market cap back in November when it missed guidance after rolling up NextGen, M2 and the Amcom businesses. Well, that's all for now. Stay tuned to the blog as we keep you informed about the important results that are announced and what the outlook statements might mean for 2018 returns. Today we've chatted only about domestic companies, but if you're interested in global businesses like Tencent, Facebook, Essilor and Alibaba, companies that dwarf even the largest Australian businesses, be sure to download an application form for the Montgomery Global Fund. That's all from me this week. We look forward to seeing you again soon, and please follow us on Facebook and Twitter.